So let's say your your retirement is 5 years away, or if you want to be more conservative, retirement is, let's say, 10 years away. That is when you can start diversifying out of equity. Now, this is easier said than done. Initially, when you are young, actually we see that the portfolio has a substantial debt allocation. When they start approaching their 35s, that's when the earnings increase. You are now at a mid-career level role. That is where we aggressively guide individuals to invest in equity, to build up an equity portfolio. And then once you start approaching your retirement, we have to get to that target asset allocation of close to about 50% debt, about 40% equity, 10% gold. That's our preferred asset allocation as you approach closer to retirement.
Folks, welcome to Paisa Vaisa. I'm your host Anupam Gupta, and on today's episode I am talking about a very important, interesting, very hot topic also, retirement planning. My guest Ravi Saraogi of Samasthiti Advisors. Ravi, welcome to Paisa Vaisa. Thank you so much for doing this for our listeners.
Thanks, Anupam. Glad to be here.
It is great to have you. Thank you. You're based in Chennai. You happen to be in Bombay. So thanks for giving us that 1 hour. Tell us about yourself and how did you land up in the RIA practice?
Sure. So, like you mentioned, I am a registered investment advisor, co-founder of Samasthiti Advisors. We do a lot of financial planning, investment advisory. We work with clients. We try and understand what the requirement is, and we help them do that. Prior to Samasthiti, we started in 2019. Prior to that, I was working in the financial services industry for about 10 years. We share a background in institutional equity research, different organizations, HSBC, JP Morgan, IFL Capital, and the last stint was at IFMR, more into asset management. So post that, started Samasthiti, and I'm from Darjeeling. If you ever travel there, let me know. I'll make a good travel plan for you.
Ravi, of late, and especially during and post the lockdown, retirement planning has come into major focus. Okay. There is, of course, the great FIRE movement that started in the US. Without going into its relevance in India, the idea of retirement planning and financial instruments to fund that plan, whether it is in the form of a retirement corpus or mutual funds to have a pathway towards that, has gained a lot of importance on Paisa Vaisa. We have had a lot of guests who've come in, spoken about this topic. You come from a very interesting angle, because you've actually written a research paper. Folks, check out the research paper. It is there in the episode description. You don't find too many people in India, especially advisors, writing research papers, right? So I want to first understand how, as an advisor, you approach retirement planning and what are the basic concepts. Let's start from there, maybe for someone who's seeing us and who's hearing of retirement planning for the first time. For people like you, even for me, the idea of stuff like accumulation phase, corpus, safe withdrawal rate, all of this is known. But if you were to explain this for the very first time, the process and some basic concepts, how would you do it?
Sure. So just a small correction. It's a co-authored research.
There's Rajan, of course. Yeah, yes. He's. I want to have him also on the show. So please give him the word that if he can come in, because Rajan has written much more. I don't know how many. What's the count of his research?
I've lost count.
Yeah. So folks, Rajan Raju, and if he's watching this, hi. Check out his research papers. I'll tell you why they're different. They are India specific. Okay, and that makes a lot of difference. India is fundamentally a very different market from developed markets. Sorry, Ravi, go on, please.
Yeah. So I think, Anupam, you've hit the nail on the head because there is a lot of research which has happened primarily relating to the accumulation phase. So in retirement, you have two phases. You're accumulating a retirement corpus, and then you're spending that retirement corpus. Now, when it comes to accumulation, I think a lot of work has happened. What instruments to use. You have, for example, spoken about NPS a lot on your shows, mutual funds. But I think where a significant amount of research has been lacking is in the distribution phase, because that's a tricky animal to talk about. An individual can spend 30 to 40 years in retirement, right? So they may have built a retirement corpus, but how do you distribute from that retirement corpus? The reason it's complex is because it spans multiple decades. In fact, insurance companies have entire team of actuaries who tasked with researching on this. So distribution is an area that we decided to focus on a lot, and that's how we got into this phase. And a lot of it is also coming because earlier when clients would walk in, they would be young clients, they are preparing for retirement, so it's mostly accumulation. But if you look at the pre-COVID years and the way the markets have done even prior to the COVID, a lot of startups started monetizing their ESOPs. There was a private market, there were IPOs. I think quite a lot people were planning for early retirement. People in their 40s were actually asking the question, can I retire and do something alternative? So we were for the first time exposed to this problem statement. Otherwise, you could just push it multiple decades down the line. But I think the way people have caught on to fire, this is a very pressing problem. How do I figure out distribution? So I may have accumulated retirement corpus. How much pension can I get, from that?
I want to go one level deeper in this. Okay, when you say that the conversation in India happens only on accumulation, folks, that's very simple. You talk to anybody, you go online, you'll find a retirement calculator, okay, which is number of months of expenses, inflation, market returns, boom, that's it, you're sorted. So it's like you actually think that you can figure out that corpus at the end of your working life, and then 30, 40 years, okay, I'm not even talking about distribution, that's what Ravi's talking about, and we'll get into that. Retirement planning is much more complex. So if you think that you can just plug in those numbers and get a corpus, that's maybe just the starting of the retirement planning process. And believe me, there are a lot of assumptions there. We'll get to that. That can just go for a toss. Ravi, how is retirement planning done in India?
So the typical way that retirement planning is done is, you have an investor. We identify what is retirement corpus in their portfolio. So they could be having a portfolio. Some of it could be used for college education, for marriage, for sundry other requirements. So the first task is to identify that in this portfolio, what can actually serve as a retirement corpus. So delineate that portfolio. Second, I think typically what is done is, you assume an equity return, a debt return, and an inflation return. And this is where things get a little tricky because you're supposed to make those assumptions for the next multiple decades. You assume a life expectancy for the individual, and then you assume some asset allocation mix. And once you have all of these inputs, what is the present corpus, what are the returns, what is the period of retirement, you can actually back calculate what is an annuity that the person can get from that corpus. So this is typically how retirement calculations have been done. Most of the calculators that you mentioned actually just do this in the back. Our listeners can do this very simply in Excel using typical future value, present value formulas.
Now let's get to the complication. Sequence of returns. It's something that is not even spoken about because you're in a bull market. And you just assume that equities will give you 12%, 15% forever. Yeah. That's not how it works. Sequence of returns.
Yeah, absolutely. So, in fact, the core issue with this approach, I think, like you mentioned, it's a great first step because many people don't even get there. So it's a great first step that you have used this framework of present value, future value, constant returns, constant inflation to at least arrive at some number. But then you have to cross a distance and make these numbers much better. Now, the fundamental problem in this computation is that you're assuming that the retirement corpus will be exposed to the same return each year. And we know that not how reality works. Even if you have a 100% fixed income portfolio, still it will not be true because interest rates change over multiple decades. Forget about a portfolio which actually has equity and talking about a retirement portfolio which might have 50% allocation to equity. So there is substantial variation. I'll give you an example because I think that's the best way to explain this. So let's take year one. You have a minus 50% return. Year two, you have plus 100% return. If you calculate an average, so that's 25%. So on average, the portfolio has made 25% return. But once you actually work out these return numbers in a portfolio, so you started with 100, first year you're 50% down, so you're back to 50. Next year, you are 100% up, so you're back to 100. The real return is actually 0, right? But the average is showing a 25% return. So this is what, sequence of return, risk is, that when you use averages, it masks the volatility. And it shows that the portfolio will actually earn much higher return than it in reality it would. Sequence of return risk tells that for a portfolio which is being subjected to withdrawals, it's not only important what is the average return that the portfolio earns, but in what sequence was that return earned. So we have to incorporate volatility. So you can actually have two portfolios, and one portfolio might have a higher average return, but it will actually end up with a lower value. So this is very, very important to incorporate. Now your typical present value, future value framework, you can't do that because you're inputting a constant R, rate of return, into the equation. So you cannot actually account for this volatility in a typical retirement planning situation, which is why methodological improvements are required.
So I want to now talk about the Jan 2024 research paper that you did with Rajan, right? First, what drove you guys to do this paper?
So there is a prelude, to that study. Like I mentioned about the different challenges in retirement planning, there are people coming to us, and based on our advice, they could potentially have quit their job and started something alternative. So there was, you had to be really accurate. So we looked at internationally how have planners, arrived at a solution. Because once you're using this typical approach, you are forced to make predictions. How do you know what equity returns, debt returns, inflation is going to be like? Internationally, the methodology that is most prominent is the safe withdrawal methodology. So I looked at that approach. In 2022, I calculated the safe withdrawal rate for India. So when we tried to use that approach in India, I realized that actually there was no research available.
So you want to just take a step back and explain what a safe withdrawal rate?
Sure. So a safe withdrawal rate is, as the name implies, what is a safe withdrawal to do from a retirement portfolio.
As in, you have reached the age of retirement.
Yeah.
You have a corpus with you, and you're now looking at funding the rest of your life, which could be whatever, 30, 40 years. So you're looking at a rate that ensures that your corpus survives for that rest of your life, if I've got it right?
Absolutely.
Please
You're absolutely spot on. And this rate is arrived at through the use of simulations. It doesn't make predictions. It actually subjects a retirement portfolio to multiple scenarios. And when we're talking about multiple scenarios, we're really talking about a lot of scenarios. You could actually do 50,000 simulations, 1 lakh simulations, or even more. And in each of the simulations, the retirement portfolio is being subjected to varying levels of equity returns, debt returns, and inflation as well. So this approach is much more robust because it tells us what you can safely withdraw, keeping in mind that your retirement portfolio can potentially be exposed to we don't know what. Internationally, this was calculated as 4% in 1994 in the US.
Meaning that every year you can withdraw 4% from your corpus.
Yeah, so this is an interesting point that you mentioned. Actually, the safe withdrawal rate doesn't mean that you're withdrawing 4% each year. It means 4% in the first year only.
Okay.
Then comes the question, what about the other years,
Yeah.
right? The other years, you simply need to withdraw and make it inflation indexed. So when you look at a retirement problem, most people frame a retirement problem as what should I withdraw from year 1 to year 30. That's not required. You only need to solve for what should I withdraw in year 1. Because once you fix year 1, year 2 is simply year 1 plus inflation, right? So essentially the safe withdrawal rate is what should I withdraw at the start, and I will withdraw after that inflation indexed withdrawals so that my retirement corpus doesn't go down to 0 before my life expectancy. So this was 4%. So if you have a 100 rupee retirement corpus, in the first year, withdraw 4 rupees and then increase it with inflation.
This is a 94 study in the US.
Yes, it was done by a financial planner, William Bengen. It's a very famous study. That is what started this movement. Post that, there were several other studies Some took the rate higher to close to 5%. People explored different asset allocation mix, different instruments as well, rather than just debt and equity. What if we introduce gold? What if we introduce international investments? But unfortunately, nothing like this had been done for India. So in 2022, that was a single paper. I did that study. The reception of that paper was exceptionally bad.
Okay.
It was trashed. People, because I had calculated a 3% withdrawal rate.
Wow. This is a precursor to what you did with Rajan.
Yes.
Oh, okay.
So initially I did it myself. The reception was extremely poor. People said 3% is too low. I think the message, was universally trounced. Neil had written about it. He got a lot of flack. In fact, the reception was so poor that I actually started doubting whether I had done things rightly or not. In 2023, I had a good fortune of meeting Rajan. Like you mentioned, his body of research is excellent. He is an IM alum. He is a visiting faculty there as well. He's now retired and manages his own family office, spent many years in the financial services industry. And we got talking about it. And then we decided to take this up again. And Rajan brought a lot of firepower into the methodology. We, upgraded it. We did a lot of other things. We ran more simulations. We tried to be as technically correct as possible. And the results were validated. The second 2024 study proposed a withdrawal rate of 3 to 3.5%. And I think that gave me a lot more confidence to talk about the research and be confident that, yes, this is what it is.
4% and 3.3% and 3.5% is huge. When looked at a 30 to 40 year post-retirement timeline for that, what were the differences? What is different from the US's 4% and your 3 to 3.5%?
I think it boils down to volatility. If you look at the volatility of equity returns in India, it's more volatile. So that's one. And second is we are not getting enough real returns in debt. So for an Indian investor, when you look at the returns that they make on a fixed income portfolio, it's not very remunerative. Now, that doesn't mean that we increase the share of equity in the portfolio, because it's a very natural reaction that people have that, okay, you have got 3 to 3.5% withdrawal rate. The way I'll take this higher is by taking the share of equity higher in the portfolio. Now, we always emphasize that the reason why the withdrawal rate is 3 and 3.5% is because of volatility. Right, whether that volatility is in interest rates, in real returns, equity, all of this is contributing to that 3 to 3.5%. You cannot overcome that by introducing more volatility in the portfolio. So in fact, our research paper makes it absolutely clear that you increase the share of equity beyond 50% in a retirement portfolio, you actually get worse outcomes. I think this is not an easy thing to grasp. It's counterintuitive for us as well as researchers. So it's understandable that people find this,
Very interesting.
And I think the way that we explain this is that when you increase the share of equity in a portfolio which is not subjected to withdrawals, that's perfectly fine. Equity will really work well. But in a retirement portfolio which is being subjected to withdrawals, it can be very, very devastating. The reason is that if that portfolio is exposed to 5 to 7 to 10 years of bad sequence of returns, that actually eats into principal. So when the good returns come, you're actually depleted the portfolio and the compounding process is not as powerful. So unfortunately, increasing the share of equity doesn't help. I would also like to mention that there is very little author bias that creeps into this. In fact, people label us, are we being conservative?
We'll get to that. Yeah, I know. There was a bit of a... So, folks, to make this a little bit more simple, when you say that you can withdraw 4% and when you say that you can withdraw 3%, remember that what you have in your hand to spend is that much lesser in India, and therefore I assume you have to work towards a higher corpus, if I've got broadly the implications, So if I were to just go to maybe the one or two or three implications of this to me as a person who's planning his retirement, what would be the implications? We'll of course get to the retirement planning process after the break, but just top of line, what are the implications of your study?
Sure. So I think people focus a lot on this 3.5%, which corresponds to a 33x expenditure cover. And I think I would like to emphasize that this is a stylized study. The 33x slash 3% number may be relevant to you, may not be. It depends on your individual circumstances. I would like the key message that people take from the study is about a methodological improvement. And that's what the fight is really about, that let's stop retirement planning using point estimates. Let's stop doing retirement planning based on how the past 10-year market performance has done. And let's think about retirement planning that you could have a diverse set of outcomes and what is the risk that you want to take. So I think that's the first message, that let's cross that hump of doing this better. Then we can always talk about, what are the numbers. And see, if the earlier methodology did not account for volatility, and the next methodology that we are proposing accounts for volatility, there will be an increase in corpus. I mean, it's just math. You need a larger corpus to account for that volatility. So that's a message, of course, which is not taken well. We think that our study also highlights the importance of diversification, because once you start understanding sequence of return risk, you start appreciating the fact that the portfolio has to be, less volatile. That is when, you start diversifying a portfolio. Our study, for example, shows that a 10% introduction of gold can take the withdrawal rates as high as 3.5 to 3.75%. So I think these are the key, messages, which are there in the study.
Ravi, let's talk about the controversy. Okay, because here we are on, in the bull market Nifty at about 24, 25, 26,000. Last 4 years, equities have given whatever return they have. And, here you're coming saying that, listen, equity introduces volatility. You need to do diversification. You need to bring gold. And obviously people will say that, bhai, because your assumptions seem conservative, your corpus looks unrealistic. मतलब यार अभी बंदा काम कर रहा है 30-40 साल काम करेगा, कितना कॉर्पस जमा कर सकता है यार, especially for someone who's middle income. If you tell him, at the age of 25, 30 that you need like 20 crores or something, तो थोड़ा तो it becomes a bit of a rude surprise. But on Twitter, Neil posted the article and it went into its own zone. Talk to us about the pushback and what that revealed to you in terms of thinking, right? And I'll give you some background to this. It's just that we are currently at a phase where we are assuming that equity returns will be at 15% forever. So what goes into that calculator is this random number of 15% or even 12%. And you'll find all kinds of logic for it, okay? Where GDP growth plus inflation. So utna to market dega. That's not reality, okay? So first, what was this pushback? This stuff that happened on Twitter, what was that about?
Sure. So in fact, when Neil posted that article, the feedback was similar to what the feedback was when I first released that study in 2022. And that was, again, that this is too conservative. This doesn't make sense. And I'll circle back to that point that I made, that whether a planner is being conservative or aggressive, that happens when the earlier methodology is being used, because there the planner is using a return assumption. So when the retirement corpus is very less, you can say that has the planner used very aggressive returns. And if the retirement corpus turns out to be very large, you can always question, has the planner been very conservative? Now, in the safe withdrawal methodology, we have not dictated any return. We have simply asked the simulator to look at the last 25 years return and simulate different outcomes. So there is absolutely no case for us being conservative or aggressive. I mean, this is just what the data, suggests. Now, history may not repeat, but history rhymes. When you want to model equity return, debt return, inflation, these are very, very complex variables. Federal Reserve gets it wrong. Central banks get it wrong, right? So you can look at historical how these variables have done and use that as a guide in your simulator. So the simulator is simulating different values from the last 25 years and showing us an output. So that's the first point. This is not about being conservative at all. We have not been conservative at all. We have simply used historical data, and that's what. It's just that we are using past 25-year data. Somebody may be having an anchoring of past 5 to 10-year data, and then of course, things may appear conservative. So that's the first point. Second, there was a lot of criticism that let's look at how a balanced advantage fund has done over the last 10-15 years. Let's look at how NPS has done. But that again is not a valid criticism, because that's exactly what we don't want to do. We don't want to look at a single stream of data and project that into the future. So I think a lot more needs to be done, perhaps in explaining this research, in explaining concepts like these. But essentially the pushback was that, okay, these numbers look unachievable. I have seen there is a cognitive dissonance when we look at these numbers. So if I were to tell one of my clients who's 40 that you need to accumulate 10 to 15 crores when you are 60, there is a shock.
There is a shock.
But it's not 10 to 15 crores now. It's 10 to 15 crores 20 years later. And when you reduce that number to a step-up SIP, it suddenly starts looking manageable. So we are not talking about these retirement corpuses right now. These are all future value numbers. I think when you discount them back, the math actually works for most people. We use this methodology in our client base. I don't think it makes the achievement of a comfortable retirement unachievable.
Yeah, it's like you said. It's just that optically that number looks very large.
Yes.
And if you do stuff like step up SIPs and increase your investment rates and all that, I think mentally, emotionally, because there's a lot of this is also emotion.
Yeah.
You get the idea that you will have to have a very, lesser lifestyle, so to say. You'll have to save more, spend less, and that is not a very comfortable place to be in at any age. You want to have a comfortable life while also saving. I mean, it's just that when this shock comes to you, you feel that only one is possible. What happened to my travel plans? Nahi hone wala hai na abhi. Because if these are the numbers that you're talking about, then obviously I need to be a little bit more conservative in my spending and stuff like that. Is that generally true?
I wouldn't say that, Anupam, and this is not to sugarcoat things. See, there is, of course, building a large corpus does require discipline, and there's no two ways about it. But I have not seen situation where it's difficult. Only cases where it's difficulties where the expectations are wild. If we are looking at a very large pension income during retirement, of course, we will require a large, corpus. Most people acquire a house during their working years, so they are looking at no rent expenses.
No EMI also?
No EMI. Kids have gone to college. There are no expenses relating to that. Most parents now actually don't budget a large marriage expenses as well. They would rather build a large education corpus. So it's not like even marriage is going to take up a lot of money. So we do see that the math works out. It's just that, it appears a very large number, but for a disciplined investor, we don't see it as a challenge. We also like to highlight, and what we also see in our work is that when you start talking to individuals, they always have a lot of levers to make things work. So ऐसा नहीं है कि you are 60 and आपके पास 33x नहीं है तो आप road पे आ जाओगे. You always have things to fall back on. Some people, for example, were planning to leave a large inheritance for their kid, or at least 1 or 2 houses. Now maybe we'll have to monetize that. Sometimes people pick up some small freelancing opportunities, and these small things can actually make things work. We also see that at the end of the day, when in that research, the idea was how do we present these numbers with a low failure rate. So we have modeled for a 5% failure rate. So these numbers will ensure that 95% of the times you are safe. But there could be cases where individuals are willing to take more risk, and it's in the temperament, right? And when you lower that failure rate, so if you are okay with a 10% failure rate or a 15% failure rate, you can actually do with a lesser retirement corpus as well. And most importantly, this is an area of research that I and Rajan are going to address in our subsequent paper release, is that can the withdrawal rate be made dynamic? It's critical that first 5 to 10 years in your retirement, you be conservative, because the sequence of return risk is very, very damaging in a retirement portfolio if the portfolio is exposed to poor returns early on. So early on, it's very, very important to protect the retirement corpus. Once you have seen the first 5 to 10 years and you have not been spectacularly unlucky and you have even earned average returns, post 10 years, the withdrawal rate can be taken higher. So, so this is just about being conservative in the initial years, and most importantly, 5% of the times you will still have a failure rate, but that means 95% of the times your retirement corpus is actually a huge positive number.
Yeah.
So
I just make this a little bit more practical to our listeners now. And if you take an example of a shock to the corpus, let's say March 2020, when the entire market fell very, very sharply, and we all know what happened later.
Yeah.
So you're saying at that point of time, having a low withdrawal rate will actually help you because it preserves your corpus. Have I got that right?
No. So the safe withdrawal methodology is supposed to account for such crashes.
Okay.
So what I'm saying is, you just started your retirement, you withdraw 3 to 3.5%. Irrespective of how the market does, because that number actually bakes in multiple crises, multiple market falls. That number bakes in 2008, the 2000.com crash, 2013 taper tantrums, then the COVID crash. So that number is actually quite resilient to market falls. What I'm saying is that you have retired, and let's say the first 5 to 10 years of your retirement, your portfolio was exposed to a good sequence of returns.
Sure.
That is where you can actually increase the rate.
Okay. Now let's start the practical part, the last part of this episode for our audience. If you can just explain, let's take maybe 3 scenarios, 25, 35 and say 40 or 45. For people at this age bracket, generally what should be their approach towards retirement? Let's start with someone who's just starting his career, as a nice 30, 40 year timeline. What are some basic precepts, concepts that you would like to leave the someone who's at that age with right now when it comes to retirement planning?
Yeah. So, the key themes that we get, from the study is maintain diversification. Now, in the accumulation phase, you can actually run a concentrated portfolio. So in the distribution phase, you have to ensure good diversification. But if you are young, building a good retirement corpus, you can actually even work with a 100% equity portfolio.
Okay.
Right. So you can really go all out in terms of risk in your accumulation phase, provided there is a sufficient runway, in front of you.
And what's a good saving rate for this person?
It's really subjective. I don't want to comment on a number, because what we see is it's actually very...
Historically, household savings in India were at what, 25%?
30%.
30%, but that's obviously coming down now.
Yeah, it's coming down. I think if somebody is saving 30 to 40% of their salary, I think I would rate that as a very good number.
30 to 40%, so that's a, after the way inflation is going, I'm not sure whether that would be feasible.
And
Chalo, theek hai. So you're saying that it's good to consider more risk, concentration, because you're young. You've got a nice long time frame for you to look forward to, and look at a high savings rate, folks. So that's your key takeaway. If you're at that age, you've got a long runway. Fast forward 10 years. Now you're 35, got a family, have kids, need to do a lot of planning. Now how do I tweak my approach to retirement planning?
So what it's important to do is, in your portfolio, you need to run segmented portfolios. So let's say you have a goal for education, that will have a different asset allocation. You are saving up money for your marriage, that will have different asset allocation. So it's important to bifurcate the assets into different end use. What you are actually investing for retirement, nothing needs to change even at 35. You can still maintain a very, very high proportion of equity. It's only when you're approaching retirement. So let's say your retirement is 5 years away, or if you want to be more conservative, retirement is, let's say, 10 years away. That is when you can start diversifying out of equity. Now, this is easier said than done. Actually, we come across an opposite problem, because what happens is when young people, they start working, they'll have a tax deduction into their NPS or EPF. So actually, people start with a heavier debt portfolio than required. People also open PPF accounts, which is a good thing. And so initially, when you are young, actually we see that the portfolio has a substantial debt allocation. When they start approaching their 35s, that's when the earnings increase. You are now at a mid-career level role. That is where we aggressively guide individuals to invest in equity, to build up an equity portfolio. And then once you start approaching your retirement, we have to get to that target asset allocation of close to about 50% debt, about 40% equity, 10% gold. That's our preferred asset allocation as you approach closer to retirement.
Okay, so we've covered that part also in a certain way, but anything still for the guys who are just about at retirement, what should they generally keep in mind? Don't mess much with your asset allocation, because now you're at the end and you want to preserve your portfolio. You think that's a good thing to do?
Yeah, so as you're approaching your retirement, we see that there is a lot of benefit of diversification. And I keep coming back to this because the only way you can take up your withdrawal rates higher is by controlling sequence of return risk. So you have to introduce a lot of diversification. In fact, one area of research that we are doing and that interests us is looking at low volatility as an investing style. So there's been a lot of work done internationally. The idea behind reducing sequence return risk in a portfolio is not to increase fixed income allocation. You can actually have close to 40-50% equity allocation, but of a low volatile nature.
Okay.
So a lot of work on that front.
What did your paper tell you about these last 25-year returns for equity and debt? What were they like?
So we are looking at Nifty returns of around 12%. Debt return was barely 1% real return on debt. That too pre-tax. Post-tax, it can actually go lower than inflation.
Can you just break that down for me? 1%? What's inflation and what was the...
So broadly, the inflation, if I recall correctly, was about 6% inflation.
And that's the debt returns?
And that pretty much, 7% was the debt return. So there's a 1% real rate of return. Equity, again, if we take a arithmetic average, it will be 12% CAGR. But these numbers actually overstate the return potential, because like I mentioned, these are arithmetic averages. Once you incorporate a geometric average, these numbers actually come down lower. In fact, Rajan has done an excellent study. He's looked not at arithmetic return of different asset classes, but geometric return. And there's a clear 2 to 3% fall. And that's because, geometric returns will incorporate volatility.
Yeah.
So in our simulator, the reason why the outcomes don't improve when you actually increase the share of equity is that volatility is very, very damaging, to the portfolio. So and the reason why we took the last 25 years data is because there's a clear break, a structural break in asset returns around the year 2000.
2000, correct.
Pre-2000, if you look at the pre-2000 2 decades,
way too high.
It was excellent.
Yeah.
And if you feed that into the simulator, you can actually get any withdrawal rate that you want. So we actually had to skip that data because it was not representative of how things are now. And we also see, of course, asset returns falling continuously. So as nominal, as inflation has come down, and nominal headline numbers also have come down. And that is beautifully captured in the simulation because we have taken that entire 25-year period.
Yeah. So if we talk of a nominal return, you're saying 12%. So 50% of my portfolio gives me 12% return. That may be 6%, and 50% gives me 6%. That's 3%. So I'm looking at 9% blended.
Yeah.
I'm looking at 9% blended, and debt, of course, the volatility is much lower. Equity is probably a little bit higher. So accounting for all...
We have factored in tax as well. So we have factored in 10% long-term capital gain tax. This was done prior to the recent increase. And we have factored in 30% tax on the fixed income portfolio.
But you're saying that 12% is post-tax?
12% is pre-tax.
Pre-tax, that's what. I don't introduce tax. I mean, that takes it into a different thing. I mean, just keep things simple.
Yeah.
So you're saying blended returns of just 9%. Man, that's going to need a very high savings rate.
Yeah, and that too, it's pre-tax.
Yeah, that too, it's pre-tax. I'm saying that, tax is... So see, the thing about falling asset returns, which obviously will happen. See, India is getting into the habit of saving and putting money into equity with SIPs at 25,000 crores. So obviously, asset returns have to fall. All mature markets have seen that. Not just India, but the history of US, UK, everywhere else has shown that as retailers come in and the blend changes, returns have to fall. But the good part is volatility also tends to stabilize. Like if I look at the 80s and the 90s, in India were wild. They're like plus 100%, minus 40% and all that. So that thankfully is now coming down. Volatility also thankfully will come down. What do you think is a good number to leave with our listeners? I mean, like when you do financial planning for your clients, what numbers do you work with for the future?
So we actually don't project because we simply use the historical simulated numbers. So we use 3.5%. Individual circumstances.
3.5% is a
withdrawal rate.
Withdrawal rate, but the portfolio returns for the various asset classes, like how much you use?
You don't have to actually do that.
Okay.
Because the moment you do that, it's again a problem because we are again committing that same crime. So the beauty behind, in fact, the reason why I like this approach is because it liberates you as a planner, as an investor for making return assumptions. This 3.5% number has all kind of returns baked into it. Some very good returns, some very bad returns, everything. So you don't actually have to project any return. This 3.5% number will work irrespective of how the markets perform.
I'm guessing,
unless it's a Japan kind of situation where 1990, 30 years, zero return, those will fall under the 5% failure rate category.
We had a lost decade in 93 to 2003, zero on the Nifty and the Sensex. So see, your clients are of a certain age profile. I'm sure, you don't have the demographic of India, which is very, very young right now. I wanted to just distill this entire episode, maybe in 2 or 3 guiding factors for this demographic, the largest demographic, which has today many more options than you had when you were saving 20, 30 years ago. And we had more options than our fathers before us. What's your message to these guys when they're looking at retirement planning? Okay, now we spoke a lot about distribution, we spoke a lot about safe withdrawal rate returns, but just leave our audience with 3 general good guiding factors, principles, so that they have clear takeaways of how to start their retirement planning today.
Sure. So in fact, the first is that one clear difference that we see is that this generation really has very good expectations in terms of asset returns. And I think that's a function of the times that they are living through. They are living through one of the best phases of the market. So one, general guidance would be that, we have to temper those expectations. And this is not to say that these returns may not sustain. Who knows? It's just about being prepared. That's it. Right. The second is most people are, think about retirement planning as having a pool of capital and then, working that capital a lot in terms of turnover for generating a certain amount of monthly income, which could mean doing trading, which could be being a very active stock investor. So it's very different from how the other generation thinks about retirement planning, because there is more about asset allocation. I'm going to invest in all of this and I'm going to just enjoy and let the liquidity come in. This generation actually thinks about portfolio in a very different way. In a very active way, which I think can be a problem because the more you churn the portfolio, the more ideas you have about that particular part of the portfolio, it can be damaging to the long-term compounding process. And third, there is merit to when certain individuals who want to retire early, your expenditure will not proportionately increase with the same number of years that you're going to spend in retirement. So let's take an example. Somebody who's spending 30 years in retirement, we generally go with a 30 to 33x number, expenditure cover, first year of retirement expenditure cover. Somebody who's retiring at 50 will spend 40 years in retirement. There the number is about 40x. Somebody who's going to retire in 40 and will spend 50 years in retirement potentially. there the number actually doesn't proportionately increase. Because what happens is when you retire early, that compounding cycle in your retirement period becomes so strong that you can actually do with lesser. But there is also a flip side. It's actually much easier to reach a higher number later down the road than a smaller number early on, because your accumulation phase, so while in a distribution phase your compounding process will work magic, you have not actually had a good compounding process in the accumulation phase. So these are, and I think with respect to options, I feel there are too many options now.
Why gold? There's equity, there's debt. Why do you introduce gold? Because low volatility and
better returns than debt. So it actually works really, really well in the portfolio.
I really wonder how gold will pan out in the next, 10, 20, 30 years. It's held really well for the last past. It's just a very fascinating asset because it's got no anchor. It's like equity, you can link it to something. Debt, you can link it to something. Gold is like on metal. Its own. But listen, whatever it is, all retirement corpus will start at 15 crores. जो भी आप करो उतना तो minimum चाहिए ही चाहिए, right?
नहीं, 8, so for example, I think, scared, in many cities in India, a pension income of 1 lakh a month or 1.5, 2 lakh a month, that's a good number. And when you do the math, somebody is spending, 24 odd lakhs a year, take that 33x. That's not a insurmountable number. And I think generally when you start looking at the assets that people have, what they have accumulated in their EPF, PPF through consistent investing in mutual funds, they generally hit that number.
So be open-minded, be creative, but be logical and disciplined. Also, folks, those retirement calculators that you see online, they're a very good place to start. And we small cap, mid cap return ko forecast karte future mein, if everybody is making 25% per year, then honestly we don't need retirement at all. But anyway, Ravi, we are done with this episode. Our standard questions to all our guests on the show: what book are you reading, and do you have any recommendation for our audience?
Okay, so since we are on this retirement, topic, I would recommend a book called High Returns from Low Risk by the author Pim Van Vliet. He's the head of conservative equities and chief quant, strategist at Robeco International. He's done a fantastic amount of work explaining how you can build low volatile portfolios with better return outcomes than high volatile portfolios.
That's possible.
So it's possible. In fact, his entire edifice of work shows how standard financial market theories get it wrong, because as per our typical financial market theory, higher the volatility, higher the risk. His body of research questions that. So, and he's explained it very wonderfully in a very accessible book. So it's High Returns from Low Risk. Check that out. And the reason that body of research fascinates us is we want retirement portfolios to have equity. We want to curtail the volatility of that equity. So low volatility investing is probably the solution.
Fantastic. I love the sound of it. High return, low risk. And with that is a wrap on this episode of Paisa Vaisa. My guest, Ravi Saraogi of Samasthiti Advisors. Ravi, thank you so much for doing this for our audience.
Thanks so much, Anupam. I've been listening to a lot of your shows.
Very kind of you. Thank you so much.
It's always it's a great to be here.
Thank you so much.